Hey there! Welcome back. Welcome to the tax series. Today we'll be talking about the different types of taxes in the UK. Some taxes you might already be familiar with, like the one that comes up every single election season, income tax. Others are more obscure, like capital gains tax. These series will cover the different types of taxes, such as capital gains tax, income tax, hello, HMRC, inheritance tax, value added tax, or better known as VAT. So before we get on with today's episode, let's define what tax is. So tax is a compulsory contribution to the state revenue, which for us is the HMRC. The HMRC is longly known as Her Majesty's Revenue and Customs. Tax is collected by the government on workers' income and business profit, or added to cost of some goods, services, and transactions. So let's kick off this series with our first episode on income tax. The UK law does not discriminate. You are taxed under the UK law, whatever your age or status on your worldwide income, as long as you are a resident. So the tax year runs from 6th of April in one year to the 5th of April the next year. Income tax, as it is titled, is paid on your income. However, tax isn't paid on all types of income. Oh yes. So what exactly, or which income exactly is taxed? So what is taxed? The following items are taxed. So, the money you earn from employment, profits you make if you're self-employed, including from services you sell through websites and or apps. Some state benefits, most pensions, including state pensions, company and personal pensions, and retirement annuities. Rental income, unless you're a living landlord and get less than the rental room limit. Benefits you get from your job, income from a trust, interest on savings over your savings allowances. As mentioned earlier, some state benefits are taxed. The most commonly taxed state benefits are bereavement allowance, carers allowance, contribution-based employment and support allowance, incapacity benefit, job seekers allowance, pension paid by the industrial death benefit scheme, state pension, widowed parents allowance. The rental room limit is £7,500 per year. Anything over the £7,500 exemption, you would need to complete a tax return. That was a lot to take in. But on the flip side, what don't we have to pay tax on? The following are not taxed. The first £1,000 of income from self-employment, this is your trading allowance. The first £1,000 of income from property you rent, unless you're using the rental room scheme. Income from exempt accounts like individual savings account, which are your ISAs, and the national savings certificates. Dividends from company shares under your dividends allowance, and some state benefits. Premium bonds or national lottery wins. Rent you get from a lodger in your house that's below the rental room limit, which is £7,500 a year. We now know what we pay our taxes on and what we don't pay our taxes on. But how exactly do we pay those taxes? There are two ways to pay your income taxes. The first being pay as you earn, which is called a payee. The second one is a self-assessment tax return. Self-assessment are usually used by people who are self-employed, which are usually like freelancers, contractors, so on and so forth. The main focus for this episode will be pay as you earn, which is payee. This is because most people pay income tax through payee. If you would like one for self-assessment, please comment down below. Employer or pension provider used to deduct income tax. Under this topic, we will talk about tax-free allowances, tax bands, and tax codes. Tax-free allowance. When we talk about allowances, we talk about tax-free allowances or personal allowance. The standard tax-free personal allowance is £12,500. This could change every tax year dependent on the government. Personal allowances increases if you have additional allowances, such as marriage allowance and blind people allowance. It decreases if you earn over £100,000. The personal allowance goes down by £1 for every £2 you earn above £100,000. It can go down to zero. Marriage allowance lets you transfer 10% of your tax-free personal allowance to your husband, wife, or civil partner. This is an ideal option if you're married or in a civil partnership and only one person is earning over the tax threshold. The second additional allowance is blind person allowance. This is £2,450. This is an extra amount of tax-free allowance in addition to your personal allowance. It means you can earn more before you start paying income tax. This can be transferred to your spouse or civil partner. In England and Wales, you can claim blind person allowance if you're registered with your local council as blind or severely sight impaired. So a quick recap on what we've learnt so far before we finish this episode off. This year's tax year will run from the 6th of April 2020 till the 5th of April 2021. The standard tax-free personal allowance is £12,500. The standard tax-free allowance increases if you have additional allowances like marriage allowance or blind person allowance. Tax-free personal allowance decreases when you start to earn over £100,000. Tax ban. Just before we get started, England and Scotland have different tax bans. Once again, for the people at the back, different tax bans. The English tax bans are simpler than the Scottish tax bans. There are 4 tax bands in England and Wales. You have personal allowance, basic rate, higher rate and additional rate. There are 6 tax bands in Scotland. So, in between the personal allowance and the basic rate, you have a starter rate. In between the basic rate and the higher rate, you have an intermediate rate. And instead of having an additional rate, you have a top rate in Scotland. So let's talk about take-home pay. For calculating take-home pay, we've only deducted tax and national insurance. National insurance in England, Scotland and Wales are the same. So what happens if I was earning £100,000 in England or Wales? Well, I'd be taking home £6,000, whereas in Scotland I'd be taking home £64,598.43. This is a difference of about £2,051.57. So a month I'd be losing about £170.96. Tax codes. Tax codes are used by your employer or pension provider to work out how much income tax you should pay. The Gov.uk website allows you to check out your tax code. What does your tax code mean? Tax code normally starts with numbers and ends with a letter. The numbers in your tax code tell your employer or pension provider how much tax-free income you get in that tax year. Letters in your tax code refer to your situation and how it affects your personal allowance. W1, M1 and X are known to be emergency tax codes. If your tax code begins with a K, means you have income that is not being taxed another way and it's worth more than your tax-free allowance. 1250L is a tax code currently used for most people with one job or one pension. In Scotland, it's named S1250L. The end. Please don't forget to like, comment, share and subscribe. All the details and useful links will be in our description box below. You can follow us on Instagram for our daily postings. Thank you again so much for watching.